Hey, Think Realty Nation. Thanks so much for joining us on the podcast today. I'm super excited that you decided to join us and be a part of the show. I've got a great guest for you today, but before I get there, I want to say a quick thank you to our podcast sponsor, which is Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit Real Property MGT. That's realpropertymgt.com. My guest today is resident expert for Think Realty, Eric Stewart, and appreciate you being on the show.
Thanks for having me, Eddie.
And I'm glad you matched me today.
Yeah. You got the memo.
I'm glad. I'm very colorblind, and so I pretty much just wear blue. You know.
Well, you nailed it. I'll tell you, you look great. So.
I appreciate that. Even brown shoes. You probably can't see it, but we both got brown shoes on. So I don't know if it's you trying to be like me or me trying to be like you, but either way, it works for me.
Yeah, I know what I'm going to tell people.
Okay.
When we leave,
If you don't know Eric and you haven't followed him or you haven't gone to watch his videos as a resident expert, Eric is brilliant in the space of many areas, but especially in the space of structuring deals specific to multifamily commercial real estate. That's really the space he exists in our world as Think Realty. And I know a lot of you have gotten to a place where yield has not been your friend when it comes to your single family assets. 3, 4, 5 years ago, you were told buy your single family assets for cash flow. And then in the past 2 to 3 years, you've been told cash flow doesn't matter anymore because the interest rates are too high. So stop buying for cash flow, buy for appreciation. This is a 30-year game. And it seems like the bars are always changing, right? The field goal, like they just keep moving the field goal post, right? And so one of the tried and true asset classes that I've been in, I own over 4,000 doors, 4,137. We did the count the other day.
Nice.
And close on a new one here pretty soon, which makes it 4,138. You know, I'm trying to keep track. But anyways, it's been kind of a wild journey, but one of the tried and true asset classes I've been in is multifamily. Mm-hmm. And if done right, that's the caveat. If done right, yep, it's amazing. It really is. It's a great opportunity, and you don't have to be the guy that's got millions in his pocket to do multifamily. You can ride along with other people, and you can make small investments. Yep. I just want to know, just generally speaking, what's the market look like right now? Right? Like, what does it feel like to real estate investors that are out there getting into multifamily?
You know, if there's one word that I can use to describe it right now, it's fragmented, mm-hmm, right? And it's primarily fragmented based on your debt structure. Mm-hmm. And I know I'm biased because that's kind of what I focus on.
That's what you do, yeah.
But that debt structure is what creates the consequence, mm-hmm, right? Do you have a maturity coming up in 12 months, 6 months, 3 months? Are you going to get an extension? It all depends on what type of structure you have and your bridge debt. And the performance of the property has everything to do with whether you're going to get that extension or not.
Sure.
Long-term debt, you're sitting pretty, mm-hmm, right? You're just worried about getting those rents up. You're worried about insurance. You're worried about taxes because we've just got really kicked in the shins lately with, mm-hmm, our insurance rates.
Sure.
So they're different struggles, but that's why I say it's fragmented, because in one portfolio, you can have a red hot stress point and you can have, you know, cool blue sailing in the same portfolio.
Right, yeah, interesting. What everyone wants to know right now is what's the Federal Reserve doing, right? It's like there's so much speculation. Every time Powell comes out and he says something, everyone hangs on his every word and is like, does that mean it's going up? Does that mean it's going down? Have we hit our peak? You know, this industry is so dependent on rate, mm-hmm, you know, because it's not a game of miles, it's a game of inches, right? But those inches mean millions of dollars, right? Where are you at on rates? What's going on? Are we, you know, it's like, do you feel like you have a good feeling as to where we're at and maybe where we're headed?
I think so. I think I do, and it's because a couple things. One is I try not to get caught up on the headlines. Mm-hmm. I try not to follow, you know, the sizzle and the volatility of whatever news is reported. Not even daily anymore, because that kind of dates us.
Right.
It's every hour. Mm-hmm. It comes out and it hits your inbox constantly.
Right.
But looking at the long-term structure, looking at even you know, medium term, mm-hmm, the difference between what the Fed says in their meetings, mm-hmm, that and what they do, mm-hmm, is pivotal, right? And
sometimes radically different.
It can be,
right? Like sometimes it seems like it's in opposition.
Well, Yes, because they're data driven, and that real time data is going to impact what they do.
Sure.
And then they're going to come out and talk about it. But their statements are typically geared to reduce volatility. They're concerned about that market reaction, because I mean, we deal in the equities market.
Right.
We deal in real estate, but that equities market has a huge impact on our specific rates, because our interest rates are defined by what happens in the treasury market.
Right.
Treasury market moves based on what the equities market is doing. The equities market moves based on what the Fed says. They price it in months early.
Right.
And then what they actually do, like in June, let's say they do cut in June, is it already priced into our rates?
Sure.
You know, or now they're going to look 3 months further ahead, and we might see a little bit of a drop. But
do you believe it is priced into our rates currently?
I believe that it's priced in currently. To take your statement, yes, right now, I believe it's priced in.
Yeah.
By the time June comes around and we actually see that cut happen, because again, we're in a world right now where we're sort of plateaued.
Sure.
Remember
it's
how
almost stagnant.
Very much so. Remember what a big deal it was when they stopped raising? It was this adjustment, like we all exhaled. Like,
we all breathed for a minute. Yeah.
Exactly. They stopped raising. That was pivotal. But it was an action. They talked about it long before that.
Sure.
But it was an action. Then we exhaled. Now, if they actually do cut in June, next action piece. Now it's off to the races, and you see another move and another reset. Would I love to see in the 3.5 Treasury? Absolutely. And that's probably something else that we're going to talk about, is a lower Treasury is going to help facilitate so many of these maturities.
That's what I was going to ask you. I mean, so I'd love to hear your thought on that. Will they cut? What does the Treasury look like at that point? And then what's the domino effect?
What the Treasury looks like at that point is how hard the equities market moves. It depends on how hard the equities market moves and what they do as far as bond purchases.
Let me do this for a second. You and I can geek out all day long. And sometimes I forget that I've been in this for 20 years, and some of the language we use, they don't understand. Would you take this all the way down to the bottom shelf, explain equities, right, and explain the Treasury just high level?
Sure.
You don't have to go super deep in. I want to make sure that we're dragging everybody along with us.
Right. I gotcha. So when we talk about equities, we're talking about the stock market in general. You know, you buy Microsoft, you buy Amazon, whatever stock you are buying. You're buying equity into that company.
Right.
And the same way as you might be a limited partner in a deal, and you buy equity in your limited partnership into that real estate deal, that multifamily deal. Well, the other side of the coin are your bonds, and we've always heard of bonds, but that's a debt structure, right? That's just a stream of payments that you're buying.
Right.
They work
hand in hand,
in hand, but opposite of one another, typically.
One affects the other.
Right. So when people sell equities, you're usually going to see bond prices increase.
Yeah.
Once again, we talk about these inverse relationships. When bond prices increase, the yield or the interest rate that they pay, that drops, because
the equities start to they lack performance at that point.
Yeah, exactly.
Yeah.
So
because their debt's so much higher.
That's exactly right. So when those rates drop, when those Treasury rates drop, that's what our interest rates are based on, and we're celebrating because our interest rates on our loans go down.
Right.
So that's why when we see this, when people start buying bonds, prices go up, rates drop, and then our interest rates drop.
Okay, time in. Let's go back at it.
All right.
So we brought them along. So now we jump into this. What does the Treasury look like if we drop rate?
It's going to depend on how much the cut is, and it's also going to depend on why and what they say. If we're seeing huge issues in the economy, let's say unemployment starts to creep up. And there's
inflation numbers change in any capacity, right? If they see inflation change 0.5% or something like that, employment, right?
Exactly, exactly. That's going to have a huge impact on the volatility and how drastic those changes are. Sure. Right now, because of all, and I'm going to use a term now, and I'll use it lightly. It's not like, I'm not saying that there's intentional negative activity here, but the manipulation that we've seen over the last 20 years of rates in general kind of throws a lot of the age-old formulas out of the window.
Sure.
Like, we've been in an inverted yield curve for forever.
Right.
Everybody's tired of hearing about this recession. You know, the what is it? The Phillips curve. All those things. All those tried and true.
The Phillips curve and the conjunctive wave and all the
they're
all the economic.
Everybody's scratching their head saying, "Why isn't it working?"
Yeah, they're all wrong.
And it wasn't because it's not a fundamental cause that happened. It was manipulation.
Right.
And so we have
Which
to.
actually I believe. I mean, I'm not a conspiracy theorist in most cases. In this one, because all of this defies the very laws of economics, it shows that somebody is manufacturing our results, right? Like that's my belief. So it is manipulation to a degree.
It's controlling.
Yeah.
It's being controlled one way or the other. Right. And one would say that they have tools to use to help control the economy.
Sure.
That's what they're doing. And so they have to look at the fundamental information.
It's also cause and effect. You print however many trillions of dollars we printed, like it's causal, right? Like it's like you're creating something that will have a downstream effect.
Yeah, no doubt.
So let's take that back down to multifamily real estate, which you're an expert at. So now rates drop, right? Which is going to affect cap rates. It's going to affect how many dollars are like sitting on the sideline are going to get involved. How much retail investments are going to increase. But when I look at deal structure right now, it's such a trend that owner financing really never existed in my space, in the multifamily space, in the last 20 years, right? Like I mean, to a degree it did. But it was just people trying to avoid taxation or whatever. But for the most part, it wasn't a vehicle that was being used on a consistent basis. Now, I'm being offered from sellers owner financing deals.
Yeah.
Why should I look at owner finance deals versus looking at positioning my purchase in line with potentially a drop here in the near future?
Owner financing has a ton of benefits to it. So, and by the way, at the Think Realty conference, I think you've got Pace more.
We do. Pace will be here tomorrow.
I mean, that is his thing.
That's his thing.
So, I mean, it's a huge name there. So we definitely want to see that. There's a ton of benefits to it, but you have to use extreme caution too, right? Because there's scenarios where you may come in and skimp on your third-party reports. You may come in and over-leverage with too short of a maturity term. There's a lot of things you have to watch out for. And maybe it's a way for you to get in if you are not bankable, if your credit's not where it needs to be, you don't have the liquidity that you need, something like that. So there's a lot of benefits to the individual. If that seller is willing to accept a lower interest rate, if he's willing to offer a higher loan amount, that may be great for you.
Right.
It may create a very attractive structure. So the benefits really depend on the need and what they're going to fill. If you need it because your credit's bad, which clearly that's not the case, then your seller has to provide you with a more attractive debt structure than what the banks will. They're probably not doing, they're not looking at debt service analysis. They don't have LTV issues. They have another opportunity they want to take advantage of. And so yeah, it's going to vary depending on the need of the person.
So if we think that there is an impending drop, should people that are investing today in multifamily wait out that drop, or should they get involved now? What's the benefits of buying now versus buying in June?
I'm so glad you asked that. That wasn't even planned, but I'm so glad you asked that. In my experience as a service provider for 20 years, and I've been buying and investing in GP since 17, right? These deals that we set up, especially when you buy long-term debt, it's a snapshot in time. So if your deal works at today's rates, high fives, low sixes, mid sixes, if that snapshot works based on your rental increases, based on your expense model, and your exit strategy is where it needs to be, buy it. End of story, buy it today. And then create another snapshot. A snapshot in time, right? Don't wait, don't not take a picture because the next one's gonna look better. Create that investment structure and let it go. Create another investment structure at a lower interest rate because the price might be higher, and let it go. And that's what you're going to do if you're in this business long term.
I was questioned. I was buying a multifamily deal a couple weeks ago, and I had a pretty sophisticated real estate investor say to me, "Why are you doing that? Why are you doing it right now when you know there's a potential drop?" I said, "To me, I think you just answered your question." I said, "Because if I buy it now and the deal makes sense now, do you know what I make later if it drops, right? Like I said, I look at every deal I do as an arbitrage, right? Like everything. I don't look at my 4,000 units for how they perform individually, which I do. I look at how the whole portfolio performs together, right? Like from an arbitrage standpoint, think about it. If I've got a value add deal that I have a bridge loan on now, and I can get that thing to perform, and all while rates drop, and it pencils out today at today's rates, I am winning at an exponential level at that point.
Absolutely.
Yeah.
It works in your favor. It helps your projections. It worked out where it was, and
right.
And
that's what I think people miss out on. Is I think that when they hear rates are going to drop, most people think, oh, well then I'll just wait till they drop. By the way, everyone else is too. So that means demand's going up, right? Like if rates drop, do you believe that the market is going to go crazy and people are going to start jumping in?
I think there's so much equity on the sidelines. If a couple things happen, if rates pull back a little bit, at least, what's a little bit? 75 basis points.
Yep.
That would create so much liquidity. And then if sellers can just come off a little bit on these expectations, all these syndicators out there, they're not going to,
they're all hurting right now anyways, but. Yeah.
No doubt, no doubt. If they can find a way to make their deal work at a lower exit point, that's going to be big, right? So there's a few things that have to happen. I think one of the biggest things, and this is such a topic now, is all these troubled refinances. If rates pull back a little bit and they allow for those refinances to happen, they allow for these wheels to start turning again, that's going to be a huge component in our market.
Yeah. We're out of time, but last question. You just hit on a point that I see every day on Main Street investing, right? These Main Street investors, they're in that window where they didn't underwrite for the peak at which we are at now. They underwrote for something less, right? And they're in these deals that they're getting pinched right now, and they're holding on. And they're hoping that rates drop in the very near future. And they're having liquidity issues, they're having balance sheet issues, they're having all kinds of issues getting to this long-term debt. What's your advice for them?
If you can hold your breath, hold your breath.
Yeah.
Right? If you can find someone that gives you a reasonable solution to exit, make the smart solution.
And by the way, you and I are both reasonable guys, right?
We
like,
are.
We like
very reasonable guys. Very reasonable guys.
We like those deals.
Well, and I think communication is key.
Right.
Reach out and talk to somebody and communicate. If you bury your head in the sand and just that childish mentality of just closing your eyes and thinking nobody can see it,
it'll all go away. Yeah.
It doesn't work.
No,
so communicate and if you can hang in there, hang in there.
The cavalry's coming, right? It's like I think that it's so important. I love what you said there, because if you can hold on, like I really do believe that a better day is coming. But also to your second point, it's like people want to help. Like I love getting those deals. I've told you the last 2 deals I've been in, it looked just like that. Like there's a lot of people with liquidity that understand the future of what's about to happen, and they'll leave you in the deal. They'll let you participate. They'll let you, like they want to take advantage of it as well. So don't let the thing crumble to the point where it's unsalvageable. Like take action, communicate with people that are sophisticated in this space. They'll help you if a deal's a deal, right?
That's right.
And reach out for some help.
Finding the problem, anytime you present a problem, you present a solution, someone else sees the value in there. If it's an opportunity for them, it's what you did in the first place, is create opportunity. Do it again.
Do it again. If they want to find you, how do they find you? I mean, obviously they can see you on Think Realty, but in a personal way, how can they reach out, talk to you, find out if you can help with some of their deals?
No, all the socials, Facebook, LinkedIn, you can certainly find me there. Good old phone calls, always nice. Shoot me a text. My website, AtlanticIC.com. Reach out to us there. And I'd love to do that. Love to have an initial consultation and talk to everybody about where they are.
Thanks so much for being on the show.
Thanks for having me.
Appreciate it. Think Realty Nation, thanks so much for being a part of the podcast. I always appreciate your viewership and listenership. If you don't mind, share it. Send this episode to someone else that might enjoy it or need it. And if you're struggling in your deal, Eric's a great resource. That's why we've asked him to be a resident expert. It's why we have such faith in him. We know that he can help you structure your deal. If you've got a deal on your hands and you just don't know how to actually finance it or get it to a place where it makes sense, Eric's a huge resource, and I'd love for you to reach out to him, watch his stuff, get to know him, watch his videos. It's all amazing stuff. One more quick thank you to our podcast sponsor, which is Real Property Management. Real Property Management, if you work with a good property manager, it's going to put more money in your pocket than take it out. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. Thanks so much for being a part of the show. If you haven't gone to thinkrealty.com to reserve your spot at our next conference, they're coming up all the time. Make sure you do. Quick tip. We always make the keyword podcast a buy one, get one free. So any of your upcoming conferences, if you just go on there and put podcast in, that's our little secret, okay? But I appreciate you being a part of the show. Thanks so much. Have a great day.